The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.
For millions of Americans who retire every year, the task of ensuring that your money is working hard enough to provide you with a consistent paycheck can make the job of working for that paycheck seem easy. Retirement doesn't signal the end of financial worry. In fact, for the majority of retirees, it's just the beginning. The assets you have built must be able to provide you and your family with financial security for all the years to come. That's why you need a game plan for retirement, making sure you have a plan and that your money is working hard to provide you with an income you can depend on. This is your game plan for retirement.
And welcome into Your Game Plan for Retirement, the show that challenges some of the traditional financial planning concepts and outdated conventional wisdom from Wall Street on how to build for financial success. We talk about the income allocation model that has proven to provide for more financial freedom and stability throughout retirement. And we always check in with your local income allocation advisor on the program. He is Josiah Grauso from ASC Financial Group for a retirement built to last. Josiah, welcome back to Your Game Plan for Retirement.
Hey, thanks, Peter. It's great being here.
Always a pleasure having you on the program. And we've talked about a number of the different challenges that are facing the modern retirement and retiree. And one of the things that we have seen is that as the market has proven to be more volatile over the last 15 to 20 years, and as more and more people are realizing that they are going to have to rely on their money to produce their standard of living in retirement and just don't want to deal with that risk of losing money, we have seen a lot of people moving to safe havens for their money, checking accounts, savings accounts, CDs at the bank. Even though we are seeing extremely low interest rates, we're seeing more and more people having larger sums of money in these type of accounts, which on one hand is a good thing. It means that if the market falls again, they're not going to lose a significant amount of money, but it also means that they may have missed out on some of the swings of the market. Just how do we balance properly this desire to have safety with our money with the desire to have a reasonable rate of return?
It's a real challenge, Peter. I can think of a client that ventured into my office, took advantage of one of our complimentary review processes that we mentioned on the radio show here. And going through 2008, he showed me his 401k statement, and he lost about 35% or so in his 401k in 2008. He did what I think a lot of people out there did, was shift their money over into what they call a stable fund. And basically, it's just a money market or a very, very low risk account that they have that's just generating based off of certain interest rates that are prevalent in that market environment at that time. And he kept it that way until about 2011. And here's the problem with that type of strategy. You know, we always hear that the market's going to rebound, the market's going to come back up, and eventually will. The problem is knowing if or when that's going to happen, or the time frame that that's going to happen in. And really, after the 2008 into the 2009 market correction, the largest upswing of that market was within the first really 9 months of 2009 into 2010. And he missed out on all that gain because he had his money on the sideline. Now, if the market kept going down, he was going to be protected. He was going to be situated on a side. However, he also missed out on large market gains that the market can anticipate as well. And that's where, for me personally, I'm more of a proponent of tactical and active management as opposed to a passive or a buy and hold type of a strategy, in where we're tactically able to maybe shift assets from secured accounts or from lower risk into more market growth, depending on market environment, but that's a rules-based approach that has that ability to go through. So it's not based on emotion of knowing when to buy in or when to kind of sell out.
So you're talking about a discipline or a belief system with how to be invested that might not be what everybody is experiencing when they are invested, even if they are allocated and diversified across different types of assets within the market.
It is more of a philosophy. It's more of a different approach that we have. To the side that we have is what we consider risk, shifted, that's designed for income, but this is generally for more of a growth allocation model. that we're taking a look at, but it's specifically a tactical strategy that's employed in order how to minimize some of the losses you have, but we're also able to take some of the positives. And what I mean by this is if you can limit your losses to no more than really 10% of a maximum drawdown every single year of your account portfolio, you only need to garner or gain 40% of the market upside just to kind of stay exactly at the same point of the S&P 500. So you don't need 100% of the market growth. You really only need 40% of it if you can limit the losses, because those compounding losses is what can severely impact somebody's estate.
Josiah, on the other side of this equation comes these low interest rates at the bank. And by not earning enough on our money, that creates an inherent danger all in of itself, doesn't it?
It absolutely does, Peter. I mean, this is something when you start off the show is something called lazy money. And if you think about what you had maybe in a bank CD over the last 10 years, the interest rates have really been just horrendous and awful. In fact, they just haven't even kept up with inflation. And if you think of somebody, and again, unfortunately, I've had some people who come into my office who have just loved these either just money markets or really bank CDs and haven't wanted to take the risks of the market. And I can understand that understanding, and they work too hard for their money and they don't want to see it draw down. But again, there's several other risks that we as retirees face or that we will face in our retirement. And market risk is just one of them. Interest rate risk and inflation risk are two other huge types of risks that we've got to make sure we're overcoming. For example, if my CD is only paying a 1.12% return every single year and inflation is 2 or 2.5%, essentially I'm still losing money because I'm losing purchasing power. From 1998 to 2009, you put $100,000 in the stock market and the market went up, the market went down, you're left with the same type of $100,000 in 2008, yet you lost 33% of purchasing power. And that's where I'm just talking about you're not really trying to just move accounts into safe alternative vehicles, but you have to have a healthy mix of money that you do have designated for income or guaranteed and money that you do have situated into taking a little bit more of a risk or more of a market upside or growth. And that's more of your longer termed dollars, not anything that's going to be utilized in a short term environment.
Well, proper portfolio, folks, is a balance of both safety and growth, and you want to make sure that you do have that balance. And both of those approaches do have their own sets of benefits and disadvantages. But to have a properly balanced portfolio, you need to have exposure to all different types of asset classes to have your money performing different jobs for you. And Josiah Grauso, the team from ASC Financial Group, they can help you strike that balance and find that balance with your accounts. And if you have questions, if you are adverse to the risk of the market or just turned off by the low interest rates at the bank and would like your money to be doing more for you, or maybe just not have as much risk associated with the potential for losing money, pick up the phone and give the team from ASC Financial Group a call. 800-939-8633, the number to call. Again, 800-939-8633 if you have questions, if you would like to talk anything over, if you would like that complimentary financial review and evaluation. The team from ASC Financial Group is your local resource across the Lehigh Valley and the Poconos. They help you with a retirement built to last. And again, they make their time available to you as a radio listener on or off the air after the show. Pick up the phone and give them a call. 800-939-8633. That's 800-939-8633. And I think that there has been a little bit of a competition, at least here locally with me, Josiah, is that one bank on one side of the street will offer a 0.75% one-year CD, and the bank on the other side of the street is offering a 0.8, and then the bank on the other side says, well, 2 years will give you 1%. But we're really not seeing a whole lot above and beyond that. But just the difference of a percent or two in your rate of return really can make a large difference over time because we're compounding on this interest rate, aren't we?
Sure. I mean, one of the greatest forces out there is something called compounding return or compounding interest. And that's the ability of your money that's able to grow based on an interest rate factor, and then how much that money grows that you've also gained interest. It's different between compounding interest and simple interest that you have. And the problem with that theory, if we had CD rates or guaranteed rates that were around 4, 5, 6%, we would be at a pretty good situation, but we're not experiencing that right now. We're down to just really bare minimums. We're at an all-time low, really, with interest rate in our interest rate environment. And the problem is, I don't see us getting out of this anytime in the short term. I think this is a realistic and it's more of a new interest rate environment that we have to become accustomed to, and we have to plan accordingly and strategize our portfolios to match these low interest rate environments that we have.
Yeah, that was going to be my next point, is that I think a lot of people have been waiting a long time with the thought process that interest rates have to come up at some point in the future. But we've just seen $10 trillion globally issue at negative interest rates. There are no signs or indications that interest rates are going to rise dramatically anytime in the near future.
There's none whatsoever. In fact, I think the government did increase it by 0.25%, the interest rate, about a year and a half ago, and the market kind of fell from there. And that's kind of what our government tries to do, and the Federal Reserve is try to help out with the market. If the market's growing, or if our economy's growing too fast, and inflation's going up too high, we increase interest rates in order to pull people to not have them spend as much, put more into savings. Same thing if the market crashes. We want to stimulate the economy. The market, what does the Federal Reserve do? They lower interest rates in order to kind of get people out there to spend more of their money or invest more of their money in order to kind of stimulate the market. And right now, our market's at an all-time high. However, our interest rates are really at an all-time low. It's really an opposite of each other. And so that's why I think this is going to be really more of a low interest rate environment that we have to be able to adapt to, and that hopefully those who are listening out there who have an advisor, their advisors are talking to them about this and have put strategies and plans in place that can overcome some of these low interest rate environments. And again, for those who are out there who are really risk adverse and don't want their money at a potential for a loss of 5% even, or 10%, there are still some other strategies that you can employ besides just putting your money in a money market or in a bank CD. And I encourage anybody out there, again, if that's you out there and you're saying, hey, I don't want to risk my money in the market, but I know I can't survive on these low interest rates, what else is out there? Please give us a call, set up a complimentary consultation. We would love to discuss and go over a plan that could potentially directly impact you and can solve some of these type of concerns that you have.
Well, folks, I think in this new economy, you do need a long-term outlook to have a retirement built to last, and that is exactly what the team from ASC Financial Group strives to build for their clients and the residents across the Lehigh Valley and the Poconos. And folks, if you have questions or concerns with what your money is doing for you, or how it is positioned, or the amount that you're paying in fees, or the amount of risk that you are exposed to, or the low interest rates you may be earning, pick up the phone and give a call for that complimentary financial review and evaluation. 800-939-8633, the number to call. Again, that's 800-939-8633. And I think we've outlined two distinct problems here, Josiah. One is the losses and the volatility that we may be exposed to that people are adverse to. They don't want to lose money. And the other being the very low interest rates. But there are ways to have safety and the potential for higher growth. And can we talk about where we can find this combination and what it is that you are doing to position your clients to have both the safety they desire and the ability for some upside potential above the 1% or less that the bank is offering?
Sure. I mean, if you take a look at what Wall Street's telling us, is Wall Street uses a number called the rule of 4% really to generate where their income is over asset allocation, meaning taking your assets and if you diversify them over different asset types or allocations, different stocks or bonds, you should be able to diversify some of your risk that you have out there. However, that 4% rule has a 58% failure rate, and every dollar you have has to be put into this model in order to generate that income.
And when you're saying failure rate, just let me clarify here. When you're saying the 4% model has a 58% failure rate, what you're talking about is people running out of money in retirement, people entering poverty when they're already retired and don't have the prospects of going out and finding new jobs. That's what you're indicating by failure rate.
Absolutely. I'm sorry. I really should have clarified that. But yes, the rule of 4% was actually put into existence. And then it was just a theory. We're taking it as a fact in Wall Street today. But it was put into existence by Ben Bergman back in the 90s. And if you think about what was the stock market doing in the 90s, we had unprecedented growth in the market. For 9 straight years, we were looking at double-digit returns. It was phenomenal. But if you look at over the last 15 years, we haven't had those same type of returns because we've had some really drastic market corrections going forward. And in fact, Mr. Bergman, who's now getting close to retirement, says he would never follow that rule of 4% anymore. And that real rate of return is really closer to about 1.88% is that withdrawal distribution that we should have, which is a huge difference in being, in order to have a successful retirement. For example, if you have $1 million, you're only going to be able to take out about $20,000 a year in order to make sure you don't have to run out of money. And that's why with us at ASC Financial Group, we have a different philosophy and a different strategy altogether. And it's one that's focused directly on income called income allocation. And with income allocation, your focal point is not really that number that you need to be successful in your retirement or that you need to garner what kind of distributions that come off of, but it's in order to determine what's my guaranteed sources of income and what shortfall or what kind of an income gap do I have that maybe is missing in that type of a strategy. And we take a look at to say, if we carve out some of this money, not all of what we have in our portfolio, but some of that portfolio dollars, and we designate it strictly for income, not really for growth, not really for liquidity, but strictly for income. And that's the number that we're using, that we know we can be able to have a more successful retirement because we know every month that goes by, if I've used my money that came from this income allocation, next month I get another paycheck. And you're able to draw more of a successful type of retirement, knowing that every dollar you have, you know where it's coming from. And if that account drops to zero, we're still able to have a guaranteed income stream that will pay out to us for the rest of our life. We can't outlive it. And that's the difference between income allocation. Because when longevity comes in as a risk, the longer we live, the more chances we're going to see on market corrections or low interest rate environments. Longevity maximizes every other risk that we have out there. And we want to try to take that off the table as best as possible or minimize that concern as best as possible.
And that, folks, is because you want a retirement built to last, and why you should give a call to Josiah Grauso and the team from ASC Financial Group. Pick up the phone and give them a call. 800-939-8633, the number to call. 800-939-8633. And we've talked about risk money and safe money and the potential benefits and disadvantages of each. Do you feel that income allocation falls into one of those categories, or is safer money appropriate for an income allocation strategy?
Yeah, I definitely think safer money is more appropriate for an income allocation strategy, and there's several different ones you can do out there. I will tell you that I don't believe you should carve out whatever that number is and put that maybe into a money market, because interest rates just aren't providing that stream of income that we really thought it was going to be doing, as well as if you draw money out faster than it's growing, you will have a potential to run out of money there. But there are other vehicles in place that you can utilize in order to guarantee on a contractual obligation that these streams of incomes are paid to you, no matter if there's a value left in the portfolio or it runs out. Now, you may be limited to how much you can draw out. It may not be as liquid. But again, the goal for some of these type of accounts that we have is purely for income. It's not a growth vehicle. It's not really a preservation vehicle. It's designed strictly for income that we have as a distribution.
Well, I think that's an important point, and I'd like to clarify on that, Josiah, is that you mentioned that if the account balance falls to zero, it may not be as liquid. But if we go to our brokerage institution, our financial investment house, or our bank, and our account balance runs to zero, there's not much liquidity there either, and we're not going to continue receiving any kind of paycheck. That's going to be the last paycheck we receive, and if we show up asking for another one, they might just call the cops on us.
Absolutely. And that's where some of these determinations, the decisions we make today can drastically impact where we are 10, 15, 20 years from now. The last thing we want to see happens, think about when you're working, you're paying into these retirement plans, these IRAs or 401ks or what have you. And these are typically going to be the largest these accounts will ever be. Because when we retire, typically we're not going to be going back to work. We're going to be drawing on these funds and they're going to start to diminish. And that's what the Wall Street model tells you, is that you're going to need every dollar you have in these plans as of asset allocation in order to determine an income stream coming out. But that income stream is not guaranteed. The more you're drawing out and the more that account is falling, you're actually increasing your withdrawal distribution, making that account fall faster and faster and faster. Whereas income allocation, if you're set to a certain guidelines, you know where your income's coming from, you know where your paycheck's coming from, even if that account falls to zero, they're contractually obligated to continually make income payments to you.
Well, folks, that is what having a retirement built to last can provide for you, is paychecks for life that you know you can rely on and depend on. And if that's the type of retirement that you envision for yourself, not having to worry about running out of money into the future or where that income is going to come from, pick up the phone and give a call to Josiah Grauso and the team from ASC Financial Group for a retirement built to last. 800-939-8633. That's 800-939-8633. Folks might be thinking, Josiah, well, I've got my IRA balance here, and as long as I make a reasonable rate of return or don't take out more than I've gained, then the value won't depreciate to zero. However, that's kind of a financial misconception, because even if you don't require that income, the IRS has a plan for that IRA account value, don't they?
Yeah, absolutely. It's called the required minimum distribution. And when you reach the age of 70 and a half, the government forces you to start taking the money out of that account. And whether you've gained that amount of distribution in interest or in market growth makes no determination and no factor. They still are requiring that income to be paid out every single year, and let alone that income distribution coming out every single year, that number will also increase every single year. So again, it's the same thing as even if I didn't want to take that money out and we wanted to leave it maybe to our beneficiaries, if we, because we don't want it, we don't need it, we don't want to pay tax on it, the government forces us to draw that money out. And in fact, for anybody who hasn't drawn that money out and is over that age of 70 and a half, the penalty the IRS imposes is one of the largest that the IRS has. It's about 50%. So if I'm supposed to take out $10,000 a year out of my IRAs or 401ks, and I didn't take that out, I now have a penalty of $5,000. It's going to be assessed from the IRS. It's one of the largest and most costly type of penalties that are out there, and that's where you want to make sure that the person you're working with who's helping manage your funds and your accounts has a very good knowledge and understanding of what happens as somebody gets into retirement. Keep in mind, folks, there's 3 different ways that your money grows. The first stage is accumulation, is really just growing of your money. And that's really the phase that most advisors really focus on only. But then there's 2 other phases. The second phase is preservation. Now that I've grown this money, I want to make sure it preserves and it lasts for the rest of my life. And number 3 is distribution. How we can take it out as effectively, either tax effectively or income amount wise, how we take that distribution that could be in a safe and maybe in an increasing stream of return so that we cannot hurt ourselves going forward in the futures, 5, 10, or 15 years down the road.
Well, folks, again, if you have questions, I highly encourage you to give a call to ASC Financial Group for a retirement built to last to understand where you are in your financial phase in life and assess whether or not your money is truly in the position to provide you with the benefits of achieving the goals that are present in your current financial phase in life, whether it be accumulation, preservation, or distribution. The team from ASC Financial Group does have access to the tools and strategies that can help you achieve your financial goals. 800-939-8633 is the number. Again, that's 800-939-8633. But Josiah, specifically as we are in that preservation or distribution phase, as we are nearing or already into retirement and maybe making our way through retirement, if we are ages 60 to 70 years old or beyond, and our advisor has not had the conversation of RMDs with us or has not talked to us about strategies that can help us maximize our sources of income, such as Social Security or pensions, my question has to be, what other topics could they be missing? And is that an indicator that somebody needs a financial review and second opinion?
unfortunately, I'm not here to put down anyone else in my field or profession or anything else, but too often I have seen with people's portfolios as they come in for a review with us is that they've got an allocation that's as an investment structure for somebody who's 30 years old and they're 65 getting ready to retire, and that they have way too much risk that they've got in their portfolio and they didn't even know it. And it doesn't mean that their advisor is a bad guy. They may not be asking right questions. See, here at ASC Financial Group, this is the area that we specialize in for those who are in or nearing retirement. And in this goal, in this age, one of the things that we're taking a look at is we're just trying to make sure we can cover some of these big concerns that have. Again, if you've got a huge market drop down in your portfolio and you're now retired, I highly doubt that portfolio is going to get back to the way it was before because we're starting to draw income off of that. We're going to be affected with sequence risk. So we can't have the same strategy in our retirement that we had in deferment before we were drawing our money out. And so if your advisor is not talking to you about these types of objectives and concerns and risks that we have kind of going forward, I encourage you, please pick up the phone, give us a call for a complimentary review. And to kind of really stress on that enough, this is all about becoming financially successful. And we believe that anybody can be financially successful, okay? But it doesn't mean how large your paycheck is or how large your asset is, how large your bank account is. Being financially successful is what we believe is making correct or right decisions with what you have or what you have available to you. And we believe that the more informed our listeners are, the more informed our clients are, the better decisions that they can make. And one of the things that I want to make sure is stressed in the show is when we offer a complimentary review, it's not designed that every one of our listeners is going to become a client. That's not how it works, and that's not what it's for. But it's designed to give you information and education, understanding where you are. When we do this review process, we take a look at what your goals are, what your objectives are, and how your assets or how your money is being utilized to compete or to overcome some of the objectives or to work with the obstacles that you have in place. And when we do this type of review process, we can give you some real benefit solutions on how to overcome some of these obstacles that we have and that we take. Some of these obstacles we may not even realize. Maybe some of the risks that we're taking. What are the fees that we're paying? What are the taxes that we're going to be paying? How is RMDs going to diminish potentially the size of our portfolio? And we're going to take a look at how all of these types of objectives can really impact your hard-earned money and ways that you're able to keep more of your hard-earned money. And really, once we understand where those objectives are, where those obstacles are, and how we can overcome it, we really are able to give confidence in a decision of when we're able to retire, how long we're able to retire, and how successful our retirement's going to be. And for those of us who are already retired, we do take a look at your current income plan if you have one, and we stress test it to see if it matches up against certain market environments and how well it will come out on the other side. In the example, if we have another 2008, or if we keep in a low interest rate environment, how successful that current retirement plan is going to be. So again, I encourage you out there, if you're listening and you say, that's me, please pick up the phone. Go onto our website, ascfinancialgroup.com. We have a list of different college classes that we teach, Social Security seminars, dinner seminars. We'd love to kind of go into more of this type of information than we can in just a 30-minute radio show that we have here. But please don't just take this information and sit on it. You want to become active and take control of your retirement. And the first thing that takes a step to do it is being proactive and finding out if you're in a place that you should be or where the steps are needing to be in order to become a more successful in our retirement.
And again, that all comes back to information and education, folks, and you need to be informed about what's going on with your money and what your goals and objectives are with it, as well as what your concerns are with how your money is currently positioned. Whether that concern be volatility and market risk or low interest rates or taxes or how to produce income through retirement, that educational process can certainly help to shine some lights on some potential red flags in your current plan and show you different strategies on how to address those concerns. Pick up the phone and give a call to ASC Financial Group. Josiah Grauso here on the program. They will help you with a retirement built to last, and they do make their time available to you on a complimentary, free of charge, no obligation basis, so you can get that information and education. All you have to do is pick up the phone and give a call, 800-939-8633. Again, the number to call, 800-939-8633. 8633, or you can even get started by texting ASC to 555-888. Another great way to get started, text ASC to 555-888, or just give a call to 800-939-8633. Josiah, we always appreciate your time here on the program. Thank you for being here with us on Your Game Plan for Retirement.
Thanks, Peter. It's great being here.
Always a pleasure having you. Once again, folks, the number 800-939-8633. We'll look forward to talking with you next week on Your Game Plan for Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.